Hey everyone, before we dive in, here's something really cool. You're listening to an episode created almost entirely by AI. From the script to the voice, this is part of the AI Takeover series by Blockchain DXB, where we explore what's possible when humans hand over the mic to machines. There's little to no human involvement, and that's what makes this episode so powerful. Welcome to the future of content creation. Let's get into it. This episode is powered by Amana, the region's first and fastest growing regulated all-in-one trading and investing app. Whether you're looking to invest in US stocks like Apple or Tesla, or MENA giants like Adinoc or Salik, Amana puts the financial market at your fingertips. You also get access to gold, foreign exchange, ETFs, futures, and commodities. With over 375 assets to choose from, they've got the largest crypto selection in the region. And listen, guys, if you want to build long-term wealth without thinking about it every day and want to automate your investing, just set your monthly budget, choose your preferred categories, and let Amana do the rest. No fees, no lockups, and 100% customizable. Even better, funding your account is frictionless, and funding your account is easier than ever. You can fund your account with Apple Pay, Google Pay, credit cards, instant bank deposits, and even your crypto wallet. No friction, no hassle. And if you get stuck, Amana offers 24/6 real human customer support and personalized sales assistance. Because you're part of the Blockchain DXB community, you get an exclusive offer. Register with the code BlockchainDXB and make at least one trade to receive a $100 trading bonus credited to your account the following month. So what are you waiting for? Download the Amana app now. The link and code are in the show notes. Next up, Blockchain DXB is proud to be the official media partner for one of the biggest blockchain events of the year, the Blockchain Futurist Conference. For the first time ever, North America's leading crypto event is heading to the United States, taking place at the iconic Guitar Hotel at Hard Rock in Hollywood, Florida. Alongside it is ETH Women, happening simultaneously. Expect multi-stage panels, NFT galleries, DeFi showcases, tech demos, metaverse experiences, and more, all under one roof. It's where the smartest minds in blockchain, crypto, and AI will converge. Get 25% off tickets by using the code DXB25. And yes, I'll be there with exclusive live coverage, behind-the-scenes interviews, and spotlight features on groundbreaking projects. Mark your calendars, November 5th and 6th, 2025. Visit futuristconference.com and use code DXB25. Link is in the show notes. Next up, Blockchain DXB has two more interesting partnership news to announce. First up, with Future Blockchain Summit and Fintech Surge 2025. Blockchain DXB is an official media partner of Future Blockchain Summit and Fintech Surge 2025. Future Blockchain Summit is one of the biggest and oldest blockchain summit taking place in Dubai, going back to almost a decade, 2017 to be precise. The event takes place between October 12th to 15th at Dubai Harbour. This is where blockchain meets fintech to redefine the future of finance. 250 plus world-class speakers, 1,200 plus investors, live demos, product launches, and the exclusive invite-only GITEX Digital Assets Forum, all under one roof. From Web3 pioneers to fintech leaders shaping payments, banking, insurtech, AI, and DeFi, this event brings the entire ecosystem together. Startups, this is your launchpad. Get in front of top VCs, accelerators, and industry leaders. For blockchain and fintech companies, this is where connections turn into partnerships and dreams turn into exits. Register today at futureblockchainsummit.com. Don't just watch the future unfold, own your space in it. Remember, Future Blockchain Summit and Fintech Surge 2025. The registration link is in the show notes below, and see you at Dubai Harbour. Second partnership news kicking off from today is with the leading Bitcoin event organizers on this planet. And this year, Bitcoin Asia is taking things to another level. Bitcoin Asia are hosting a massive gathering this August in Hong Kong, and Blockchain DXB is proud to be an official media partner of Bitcoin Asia 2025. Taking place this August in Hong Kong, Bitcoin Asia is the region's premier Bitcoin gathering, where builders, investors, and innovators meet. It's really an honor for Blockchain DXB to be associated with Bitcoin Asia. Now at this event, expect powerful keynotes, bold conversations, and a headlining session with none other than Eric Trump. He will be sharing his vision for Bitcoin's long-term potential, its role in global finance, and Asia's massive impact on adoption, and a lot more. So listen up, guys. From infrastructure to regulation, privacy tools to lightning development, Bitcoin Asia connects global Bitcoin communities and drives innovation across cultures and markets. And as part of this partnership, you can register for the Bitcoin Asia using the code DXB. All the details are in the show notes below. If Bitcoin's in your blood, this is your event. So, register today at asia.btc and don't forget to use code DXB for 10% off your tickets. Bitcoin Asia 2025, Hong Kong is calling. Be part of the future of Bitcoin. Next up, Advanced Media is the largest distributor of professional video, photography, cinema, and broadcast accessories in the Middle East. They represent over 100 major brands, including DJI, Hasselblad, Red, and Rode. The mic I'm using to record this? Sponsored by Advanced Media. But what really sets them apart is their commitment to purpose. People, planet, and prosperity. That's not just branding, it's their actual business model. They've partnered with SAE Institute in Dubai to offer scholarships to students pursuing a bachelor's degree in filmmaking, each worth AED 50,000. They also run regular workshops, training programs, and tech showcases across the region. For more info, visit amt.t, that's amt.tv. Finally, let's talk about something every crypto investor should take seriously: security. And that's where Ledger comes in. Ledger is one of the most trusted names in crypto security. Their hardware wallets, like the Nano S Plus and Nano X, keep your assets safe by storing your private keys offline. That means you're protected against hacks, malware, and phishing attempts that can compromise online wallets. The company is headquartered in Paris and is constantly innovating. Their team works with world-class security researchers and regularly tests their own products for vulnerabilities. It's why Ledger wallets are used by millions around the world. Using a hardware wallet isn't just smart, it's essential. If you're serious about crypto, it's time to stop relying on centralized exchanges or browser wallets. Click the link in the show notes to order your Ledger wallet and support this podcast at the same time.
Welcome back to the Deep Dive. It is January 21st, 2026. And look, if you made the mistake of checking your portfolio over breakfast this morning, you probably need a minute.
Oh, yeah.
Maybe a second cup of coffee.
Or something significantly stronger than coffee. It is definitely a close the laptop and go for a long walk kind of morning.
It really is. We are looking at just a sea of red.
Yeah.
Bitcoin has dipped below that, that psychological $90,000 line. Trading around 89,700 the last time I looked.
And Ethereum slipped under 3,000.
It feels like the air just got sucked out of the room. And usually when we see it drop this sharp, my immediate reaction is to, scour the crypto news sites. Who got hacked?
Right.
Did an exchange implode? Did a regulator issue a subpoena?
You're looking for a villain, a face to blame for the red candles.
Exactly. But looking at the stack of research we have today, there is no villain. There's no scam, no rogue coder, no implosion. The culprit seems to be boring old Japanese government bonds.
That is the culprit. And honestly, that makes it much more interesting than a hack. We are witnessing a textbook example of macroeconomics just crushing crypto price action. It's a liquidity shock originating in Tokyo that is washing up on the shores of the crypto market in New York.
So that is our mission today. We're going to connect those dots, how a bond yield in Japan crashes your portfolio. But we aren't just looking at the wreckage. We have some fascinating pivots to discuss. The U.S. Treasury is finally changing its tune on seized assets, learning a hard lesson from Germany.
Which is a huge policy shift for 2026.
Yeah, and Vitalik Buterin is back with a critique of DAOs that suggests we've been building them wrong this whole time. And we have a story out of the UAE about digital embassies that sounds like it belongs in a cyberpunk novel, but it's actually solving a massive legal headache for AI.
It's a really diverse stack today. I mean, we're going from the plumbing of global finance right to the edge of digital sovereignty.
Let's start with the pain, though, the markets. I feel like the bond market is this massive, silent leviathan that crypto investors ignore until it wakes up and smashes something. Walk us through what actually happened in Japan.
So the specific data point is that Japan's 30-year government bond yields surged by about 3.9% today. Now, I can see people's eyes glazing over. 3.9% sounds like a rounding error to a crypto native who is used to, 20% swings in a single afternoon.
Right. In crypto, we call a 4% move Tuesday. Why does this matter in the bond world?
Because the bond market is the bedrock of the global cost of money. You have to understand the mechanism here. For decades, Japan has been the world's ATM. Interest rates there have been floored near zero, so global investors engage in what we call the carry trade.
Can we break the carry trade down to the simplest possible level? Because we hear it a lot, but I want to make sure we really grasp the mechanics of why this specific trade matters so much.
Sure. Imagine you can walk into a bank in Tokyo and borrow $1 billion worth of yen for almost zero interest. It's essentially free money. It costs you basically nothing to hold that loan.
Okay, so I've got $1 billion of free money.
Right. But you can't just sit on it. You take that cash, you convert it into dollars or euros, and you go buy assets that actually pay a return. You buy U.S. tech stocks, you buy high-yield corporate debt, or...
You buy risky assets like Bitcoin.
Exactly. You are pocketing the difference between the free loan you took out in Japan and the high returns you're getting in the U.S.
So it's leverage. It's fueling a global shopping spree with cheap yen.
Precisely. It's the engine of global liquidity. But today, that 30-year yield surged. Suddenly, the cost of that borrowing isn't so cheap. The math changes. The investors who borrowed that yen are now looking at their spreadsheets and realizing the trade is getting squeezed. The free money isn't free anymore.
So the bill comes due.
Exactly. And when the cost of the loan goes up, they panic. They have to unwind the trade. To pay back the yen, they have to sell the assets they bought.
They sell the tech stocks, they sell the crypto.
They need liquidity immediately to cover their positions. It's like a margin call on a global scale.
And that explains why everything tanked at once. It wasn't that Bitcoin failed, it was that the investors needed cash to pay back Tokyo.
That is the key takeaway. When the liquidity tap turns off, the riskiest, most liquid assets get sold first. Bitcoin is incredibly liquid. You can sell it 24/7, unlike real estate or certain bonds. So it often acts as the ATM for investors who are in trouble elsewhere.
This brings up a narrative that I feel is really being tested today. We love to call Bitcoin digital gold, the safe haven, the hedge against the system. But if you look at the charts today, actual gold, the yellow metal sword, silver went up, Bitcoin went down. That hurts the narrative, doesn't it?
It complicates it, highlights a divergence that we need to be honest about. In a moment of true liquidity stress when people are actually scared, Bitcoin still correlates with risk assets like the NASDAQ or high-growth tech stocks. It does not yet behave like a risk-off asset like gold or U.S. Treasury.
Because gold has 5,000 years of history saying, I will preserve your wealth. Bitcoin has, 17 years?
Right. Institutional algorithms still treat Bitcoin as high-risk tech. So when the risk-off signal blinks red because of Japan, the algos dump Bitcoin and buy gold. It's automated fear.
So for the listeners staring at their red portfolio, the takeaway is, this isn't about the fundamentals of the blockchain. It's about global money flow.
Correct. The macro tide went out. Doesn't matter how good your boat is. If the water leaves the harbor, you're hitting the mud.
Well, while the private market is panic selling, it looks like the U.S. government is finally learning how to HODL. Let's pivot to this news coming out of the World Economic Forum in Davos.
Yes, this is a significant clarification from U.S. Treasury Secretary Scott Bessent.
He was asked about the government's stash of seized Bitcoin. And for context, you need to remember that the U.S. government is one of the biggest Bitcoin whales on the planet, just from arresting bad guys and taking their wallets.
They hold billions. And historically, the procedure was simple. Seize it, process a legal case, and then the U.S. Marshals auction it off for cash. They treated it like a seized yacht or a drug dealer's Lamborghini. Liquidate it, take the dollars, and move on.
But Bessent dropped a bombshell. He said they aren't selling.
He did. He specifically mentioned assets from high-profile cases like the Tornado Cash.
And Samurai wallet seizures, yeah.
Right. And he confirmed that once the legal dust settles, these assets are moving into a Bitcoin strategic reserve.
Strategic reserve. Words matter. That puts Bitcoin in the same sentence as oil or gold in the eyes of the Treasury.
It's a massive psychological shift. It changes the government's posture from this is criminal contraband we need to wash our hands of to this is a sovereign asset we need to steward.
And he explicitly referenced Germany as the anti-model, right?
Right.
I love that she brought that up. It feels like the U.S. looked at Germany's scorecard from 2024 and said, oof, let's not do that.
It is a painful case study. For those who don't remember, in mid-2024, the German government, specifically the state of Saxony, seized about 55,000 Bitcoin from a piracy site. And over the course of a few weeks, they relentlessly sold all of it.
I remember watching the on-chain data back then. It was just dump after dump. They crushed the price for weeks.
They cleared the books. But if they had held that stack until today, January 2026, the difference in value is in the billions of dollars. They effectively incinerated billions in potential national wealth because they were in a rush to clean up.
It's the ultimate paper hands moment by a G7 nation.
It really is. And Secretary Bessent seems keenly aware of that. By declaring a strategic reserve, he's signaling that the U.S. sees future value appreciation. But more importantly for the market today, it removes sell pressure.
That's the key, right? It's not that the U.S. is buying more. It's that the market now knows those 200,000 plus coins aren't going to get dumped on Coinbase next Tuesday.
Exactly. Uncertainty breeds volatility. Knowing those coins are locked up stabilizes the long-term supply outlook. It's a floor for the market, even if Japanese bonds are shaking the ceiling.
Okay, so we have the market plumbing shaking and the U.S. government diamond handing. Let's shift gears to the architecture of the crypto space itself. Vitalik Buterin has been writing again.
Vitalik's blog posts are, they're essentially required reading for the industry at this point.
Usually.
Yeah.
But this one is pretty critical. He's taking aim at DAOs, decentralized autonomous organizations. And honestly, I feel like his critique validates what a lot of us have felt for years. DAOs are supposed to be the future of human organization, but in reality, they're often just messy group chats with a bank account.
That's a charitable description for some of them. Vitalik's argument is that the current model is heavily flawed because it relies almost entirely on token voting.
Which is basically, I have more money, so I have more votes.
Right, it's a plutocracy. And Vitalik argues this is inefficient for two reasons. One, it incentivizes politics and buying votes to sway a decision. And two, it doesn't actually solve the coordination problem. It just creates a system where the wealthy dictate the direction, or worse, where nobody votes at all because of apathy.
The apathy is real.
Who?
Who has time to vote on 50 proposals a week about marketing budgets and logo colors?
Exactly. So Vitalik isn't saying kill the DAO. He's saying we need to stop making more of these flawed DAOs and start building better ones. He outlines a few structural fixes that are really interesting.
What does a better DAO look like to him?
Well, first he talks about privacy. Not everything needs to be a public spectacle. If you allow for private discussions or private voting phases, you reduce the performative aspect of governance. People can vote their conscience without fear of backlash or social pressure.
That makes sense. It's like the secret ballot in an election.
Yeah.
It exists for a reason, so you can't be intimidated.
Precisely. Second, he emphasizes better oracles.
Define that for us quickly, just so everyone is on the same page.
An oracle is just a data feed that connects the blockchain to the real world. If a DAO is betting on the weather, the oracle is the tool that tells the blockchain it rained today. Vikla argues we need much more robust, unbiased ways to get truth into the system so that disputes can be resolved fairly without a mob vote.
And the third point, which I think is the most controversial, is AI.
Yes, he suggests using AI to scale human judgment.
Now, when I hear AI in governance, I immediately think of Skynet, or at least a very dystopian bureaucracy where the computer says no. What does he actually mean?
He's not saying let the AI decide. He's saying use AI to filter and aggregate. Imagine a DAO with 10,000 members. You can't have everyone read every proposal. It's physically impossible. But an AI could analyze the sentiment of the community, summarize the proposals, point out contradictions, or even predict the outcome of a vote based on previous data.
So it's like a superpowered staffer.
Yeah.
It does the reading and the summarizing so the humans can make the high-level decision.
Exactly. It moves us from mob rule to something that looks more like a digital republic. It's about managing complexity. If DAOs are ever going to run actual companies or cities, they can't rely on everyone voting on the color of the bike shed.
That feels like a mature take. We're moving from the wild west of crypto governance to something that might actually work for the mainstream.
And speaking of mainstream and actual work, we have a story out of the Middle East that blew my mind. It's a legal innovation, not just a tech one.
This is the digital embassy concept from G42 in the UAE.
Correct. G42 is a massive tech holding company there. They introduced a platform called Green Shield and this concept of digital embassies.
The name is perfect
Mm-hmm.
because we all know what a physical embassy is. If I run into the U.S. Embassy in London, I am technically on U.S. soil. The British police can't just walk in and grab me.
Right. Diplomatic immunity and sovereignty are tied to that physical patch of land. But in the cloud, that concept breaks down. If your data is on a server in Paris, French law applies. If it's in Virginia, the U.S. Patriot Act applies.
Which is a nightmare for governments who want to use the best tech like OpenAI or AWS, but don't want foreign governments peeking at their data.
Exactly. So the digital embassy flips the script. The idea is that a government, say the UAE, can use servers hosted in other countries, like in Europe, but through a legal and technical framework, those servers are treated as UAE sovereign territory.
How do they enforce that? Is it just a handshake deal?
It's a mix of treaty law and technology. That's where Green Shield comes in. It's an operational layer encryption, access control, identity management that ensures the host country cannot physically or digitally access the data inside, even though the box is in their building.
Why go through all this trouble? Why not just build the data center in Abu Dhabi?
Time and physics. Building a cutting-edge AI data center takes 3 to 5 years. You need the chips, the cooling, the power grid. But the AI race is happening this week.
So if you wait to build it yourself, you're 5 years behind.
Exactly. This allows nations to rent the infrastructure of the West, the AWS and Azure clouds, while retaining the sovereignty of the East. It bridges the gap between ambition and infrastructure.
It's fascinating because we see this theme repeating. We also have news about Saudi Arabia partnering with Daigo Solutions and AWS.
Right, part of Vision 2030.
And the condition is always the same. We want the tech, but the data stays ours.
Data residency is the new battleground. We are moving away from the borderless internet of the 90s. We are entering the era of the sovereign internet. Every nation wants its own AI, its own data borders, and its own control.
It's the balkanization of the cloud. But maybe that's the only way it can scale globally without every country banning each other's tech.
I think that's right. It's the compromise that allows globalization to survive in a world of increasing nationalism.
All right, we've covered the high-level macro-Japanese bonds, U.S. Treasury reserves, sovereign AI clouds. Let's bring it down to the ground level, to the people actually using this stuff. There's an initiative launching in Laos that caught our eye.
This is a partnership between Tether, the company behind the USDT stablecoin, and a local exchange called Bitquake.
Now, usually when I see crypto company partners with local exchange, I assume it's a marketing blitz. Sign up now and get $10.
Usually, yes, but this is different. They are launching an education program for over 10,000 people in cities like Vientiane and Luang Prabang. And the curriculum isn't how to day trade.
Which is the last thing new users need.
Exactly. The curriculum focuses on financial literacy, risk management, and cybersecurity.
We always say, not your keys, not your crypto. It's the mantra.
Aha!
But we rarely teach people how to manage those keys.
That's the gap. If you onboard 1 million people to crypto and they all get phishing scammed in the first month because they didn't understand wallet security, you haven't built an economy. You've built a buffet for hackers.
So this is about building the immune system of the user base.
That's a great way to put it. Sustainable adoption doesn't come from speculation. It comes from utility. And you can't have utility if people are terrified of losing their money. By teaching entrepreneurs and students in Laos how to use stablecoins safely, they are building the rails for actual commerce.
It's the unsexy work that actually matters. It's easier to pump a token than to teach 10,000 people about private key encryption.
But the latter is what builds a 10-year cycle.
So let's zoom out and look at the picture we've painted today. It's a day of serious contrasts.
It is. We started with fear. The Japanese bond market shaking the foundations of liquidity.
Which reminded us that crypto is just a small boat in a very big stormy ocean. Then we moved to stability. The U.S. government deciding to treat Bitcoin as a strategic asset, putting a floor under the market.
We saw Vitalik trying to engineer better human coordination, and the Middle East trying to engineer better digital sovereignty.
It feels like the industry is growing up. It's dealing with grown-up problems, bond yields, national treaties, corporate governance.
The toy phase is definitely over.
And I want to leave you with a thought that came out of an Ask Me Anything session regarding this bond situation. It's something that I think perfectly caps off today's deep dive.
The comparison between regulation and liquidity.
Right. Think about how much mental energy we spend worrying about the SEC. Who will be the chairman? What is the new rule? We obsess over regulation. But regulation moves at the speed of bureaucracy. It takes years.
It involves hearings, comments, lawsuits. It's a slow-motion car crash at worst.
But liquidity moves at the speed of light. When those bond yields ticked up in Tokyo this morning, the money moved instantly. No hearings, no votes, no judge, just immediate, brutal impact.
It's the invisible hand, and it hits much harder than the gavel.
Exactly. So as you navigate 2026, ask yourself, are you paying as much attention to the bond market as you are to the politicians? Because one of them gives you a warning, and the other one just empties the room before you even know what happened.
A sobering thought, but a necessary one.
That's it for this deep dive. Keep your eyes on the charts, but maybe keep one eye on those global yields too. Thanks for listening.
Stay curious.